what I'm looking for this week is, frankly, more of the same from what we saw last week, which is companies beating expectations. I've thought all along that this whole earnings season is about expectations and not about the actual numbers. So far, we've had 50% of the companies in the S&P 500 report, and of those, 84% have beat on estimates, and they beat by about 17%. That being said, earnings are still down 34% year over year. So it's about expectations. It's about what the outlooks that the CEOs can get. It's about looking forward. And I think that's the real catalyst, just more of the same from last week, building a base under what's gone on over the last 4 months, rebuilding our base so that we can move higher from here.
All of these catalysts are intertwined, everything that we're talking about, but there's a couple big themes that are in the market right now. How much more are you paying attention to the COVID-19 and coronavirus headlines as opposed to some of the corporate fundamentals that are coming out of earnings season, knowing full well that, yes, businesses are impacted, of course, by COVID-19?
At this point, I'm paying way more attention to the corporate numbers and the earnings and what they're saying versus the COVID numbers. For example, we added Disney to our portfolio, to our growth portfolio about 2 weeks ago. And that's interesting because some pushback that we got was, wouldn't you want to wait until after a vaccine is announced to do that? No. That would be way too late. So what we're looking at is what their numbers from Disney Plus are, what the theme parks are starting to look like as they reopen. So we're really looking for the company's language. We kind of know where we stand, and this might be a bold and audacious thing to say, but we kind of know where we stand with the coronavirus. We know that we've had another spike. We know that a vaccine is coming. We don't know if it's going to be here in November or March, right? But we know it's coming. So that part we are learning to live with, and we're learning to live with the economic data or with economic fallout as a result of it, and we're learning how to move on from it.
So Jenny, I watch you on Halftime Report. I see some of the trades that you're making. I'm curious. What do you feel about, or how do you feel about some of these COVID stocks, right? The companies that have benefited a lot. We've shown the run up in companies like Peloton and Zoom Communications and Netflix and everything else. Does that trade still have legs if we get more virus headlines going upward?
I don't think it does. I think at best those companies start to plateau. JP Morgan did a really interesting study last week where they keep their COVID recovery. They have a COVID recovery basket and a COVID beneficiaries basket. The COVID beneficiaries have outperformed the market by 35%. The recovery stocks have underperformed by 25%. So there's a 60% divide between the beneficiaries and the recovery. That makes sense on an episodic basis only, but in the long run, which we're in, looking out over the next 12 to 18 months, that wide a divide no longer makes sense. So what I think is those beneficiaries like Peloton and Zoom that you mentioned, at best, they plateau. Maybe they give a little back.
Sure.
And then the recovery stocks start to move up and close that 60% gap.